Chapter 5, Intermediate Accounting, KESO, 16th edition. We're going to cover cash flow, specifically the indirect method. Now the presentation, we break down the cash flow statement between operating activities. What cash do we generate being in the business we're in? This is where you want your cash to come from. And then we do investing activities. This would be any change in long-term assets. But for operating activities, there are two methods. We always get the same answer. It's the direct method and the indirect method. And then the last section is financing activity. This is, are we generating cash because we're borrowing money, issuing stock, or we're using it up by paying off long-term liabilities or paying dividends? Again, the only difference between the direct and indirect method is how cash flow from operations is determined. You always get the same answer. Again, there's two formats for operating activities, the direct method and the indirect method. Again, we're focusing on the indirect method. Now to do the cash flow, whether it's direct or indirect method, the first thing you need is the income statement. And you need to be able to tell from that if there's any gain and losses or depreciation, amortization or depletion, because those are estimates. We have to take those out. We need the balance sheet because we're going to explain all the changes from last year to this year. And when we add all that up, it should equal the change in the cash because that's what we're trying to explain, why the cash changed. And then we need additional information because you can't always tell from the change in accounts what's transpired. So here in our example, we have a balance sheet, and in this case, we've shown the changes in the various accounts. And what we're going to explain is this $19,000. The cash went up by $19,000. And we're going to do the indirect method. And something to remember when you're doing the cash flow statement, indirect method, is that if short-term assets go up, it is always subtracted from cash. If liabilities go up, you add it back in. So for current assets, there is an inverse relationship. For current liabilities, it goes in the same direction. So now we can do it, and we're going to have to explain every single one of these changes. We also need the income statement, and because we need to know were there any gain or losses, and then we need additional information. For instance, did we buy or sell any equipment? Did we pay any dividends? If we issued stock, what did we do it for? Was it a non-cash transaction? Did we sell any investments or buy them? Did we have any, what was our depreciation expense, and did we purchase any equipment? So for the indirect method, step one is we're going to look at the total change because this is what we have to equal when we're all done with that cash flow statement. Then I like to go through and identify what area of the cash flow statement the various line items belong. So what I have done is gone through and isolated them for operating, investing, and financing. And again, if accounts receivable, which is a current asset, goes up, it's going to decrease operating activities along with the inventory increase. Now, for the allowance for doubtfuls is going to increase because that's an estimate. It would have decreased our expenses. And any adjustments to accumulated depreciation, we would add back in. And for accounts payable, if it went up, which it did, that is going to increase operating activities. And income taxes payable went up, and that also is going to increase operating activities. Now, one of the line items was that the change in land was, and if we bought land and we gave them stock. So what that tells me is that of that change in common stock of $50,000, $15,000 is non-cash, which means the other $35,000 is cash. So we have to make a note of that. Also, we have to remember that retained earnings always changes because of changes. We add in net income and we subtract out any dividends that we have paid. Now we're going to go to the income statement and we're going to identify the various items and what effect they would have on the cash flow. Gain on sale, with that one we're going to subtract it out as part of operations. The loss we're going to add back in. The equipment would be part of investing activities and we'd show cash of $1,000. Cash dividends would be part of financing, and that would be reducing financing activity. The common stock issued for the land is non-cash transaction. The debit investment, what we have here is we know that we got $50,000 for our investment, and we also know that we bought an additional $5,000. We know that depreciation expense would be part of operations, and we know that the purchase of the equipment would be part of investing. So that's the kind of analysis I like to do on the balance sheet and the income statement, so I have the information I need to start preparing. And again, the common stock for land is a non-cash item that would be shown as a separate schedule following the cash flow, covering non-cash investing and financing activities. Okay, depreciation expense, what we want to make sure is we've explained the change in that account. So we would start with our beginning accumulated depreciation. We'd subtract out the ending balance, which tells us this is how much accumulated depreciation changed, and that normally would be our depreciation expense, except what we do know is we sold some equipment, and therefore we had reduced it by $6,000 when we back that out. So we have to add that back in, and that tells us, and it agrees with what our note is, the depreciation expense is $22,000. Now we can look at our cash flow from operations. So we're going to add in depreciation, subtract out the gain, add in the loss, subtract out the increase in accounts receivable and inventory, add in the increase in accounts payable and income taxes payable, and now we have our cash flow from operating activities. And again, we get the same total regardless of what method, indirect or direct. Now we're going to go through and look at our cash flow. We're going to subtract off what we've already used or don't need. And since we have to account for every line item, what we have to do next is look for our investing activities. And we have some investing that changed to $30,000, but we know there's detail associated with that. And we have equipment that also changed by 22, but we also know that that was affected by a sale and a purchase. And we do that, determine that by going back to this income statement with the notes, knowing that we sold equipment and got $1,000. And we know that we sold an investment for $50, but we also bought an additional $5. And we also know that we purchased equipment for $32. So now we can do our cash flow from investing activities. We have our purchase of our equipment, purchase of our investment, sale of our investment, sale of our equipment, and now we have our cash flow investing activities. Now we're going to cross those off so we can do financing activity. Now again, we know that the change of $50,000 is not all cash because we exchanged some of it for land. So that means we're going to have to adjust that. And we also know that we have our cash dividends that we have to take into consideration. So I always like to analyze that retained earnings to make sure I've accounted for everything. We know we had net income of 67. We know that we had an ending balance of 92, and we know the dividends were 70. We add those all together and we get that answer. So now we can do our cash flow financing activities. Our cash flow is going to be our long-term note, which reduced it. We paid it off. We paid cash dividends, and we issued common stock for we got cash of $35,000. So we have our net cash flow financing activity. Now we can show our whole cash flow statement. And here it is. And it equals 19,000. We would then add that to the beginning cash balance to get the ending balance. That's what would appear on the cash flow statement. Now another thing we like to look at is free cash flow. So we would take our net cash provided by operating activities and subtract out our purchase of equipment and our payment of dividends. And it looks like that might not have been a very good idea because it's a negative number, which means the company has limited financial flexibility. The other thing we can look at is the cash debt coverage. And in this case, we take our cash flow from operations and divide by our average total liabilities, and we have 34.3 cents for every dollar, which is not good. So that means they really need to improve their liquidity position for their overall financial flexibility. And that ends Chapter 5, Part 2.